When we think about the sort of litany of challenges that investors have to face right now, that corporate executives have to face right now, what's the number one thing that's concerning them?
I think it's a trifecta, right?
Okay.
It's not number one. It is the economy, it is the war, and it is AI. So these three things are coming together. Equity markets react on a daily basis to what's going on in the war. That's not how corporate strategy works. Like, you can't be making these daily things. So, what we're looking out for is what I call the 3Ds when it comes to the war. It's duration, devastation, and disruption. So duration matters. The shorter the war ends, the more, corporate strategy is not affected. Devastation, are energy assets actually devastated by what's going on, or can they open back up quite quickly? And how much disruption is there to global trade? Even if the war ends next week, if there's devastation, disruption, it will be months, if not next year, before we see some of these gas prices normalize. So that's a trifecta that's going on right now. But of course, these three things really do relate to each other.
We keep thinking about, and it's something that came up in Milken conversations, supply chains, right? I mean, everybody's doing this data center build. They're talking about they need energy, but they also need components to build all this stuff. And that's true. Pick your industry. Everybody, I think, is more domestically looking at what they can do to protect those supply chains and just tell you they're having multiple outlets. That, to me, whether the build out or having redundancy, is going to cost the world more. And just to me says we live in a higher inflationary environment.
I can't emphasize this enough. Like, chaos has a cost, right? And the more chaotic the environment is, the more of a cost corporate leaders and CEOs have to pay. Now, the great leaders are actively on a day-to-day basis saying, how can I not pay this cost? But chaos has a cost in stalled decision-making and analysis by paralysis, and in all the redundancy you have to put into the system, especially the supply chain. Look, even if we wanted to bring all of this domestic manufacturing back to make the data centers, it would be years. We're not even close to that. So our global supply chains have had a COVID shock, they've had a tariff shock. Now we've got what's going on with different things closed. So it's quite a lot right now. And again, this chaos has a cost, which you need to actively manage down on a day-to-day basis.
What is that cost?
There's a tangible cost, right? Because slow decision-making or paralysis, paralysis has a real cost for organizations, and the hidden one is actually the scariest. So when organizations keep delaying and delaying, we always give ourselves these artificial deadlines. We'll just wait until after the war to make this decision. We'll just wait until after the Supreme Court decision. Every time, Carol and Tim, you keep punting a decision, you actually, as an organization, lose a growth and performance muscle. Growing and executing in the market is a muscle, and the more you put your teams on hold, you actually lose that muscle. So the mid to long-term cost of chaos is much higher for organizations. They're actually losing this discipline and this execution muscle, which is why when we have these chaotic times, we see such a separation of the great performing companies and the average and the many who just don't fare very well.
And then there's also the cost of people. And, there's a story that we've been talking about. Executives across retail, restaurants, packaged goods are increasingly worried about U.S. shoppers with tighter budgets amid surging gas prices caused by the conflict in the Middle East. And Tim, you talked about this, the Kraft Heinz CEO saying they're literally running, out of money at the end of the month. We're seeing negative cash flows in the lower income brackets where they're dipping into savings. We have a lot of folks around this table who talk about market highs and wealth creation. I get it. That's all good, but it's not trickling down, and I feel like there is a cost to society and economic growth and just, our quality of life here.
So the K is here to stay, and some folks who want to argue against it will find these micro data points.
The K
is here to stay. The K-shaped economy is here to stay, and we continue to have more and more data reinforcing it. Now, it's not accelerating as much as it was at this time last year, but the data is still showing that our equity markets are being propped up by a very small number of consumers. Consumer spending is led by a very small, 50%, still that 10%, that figure last year still holds. And if you dig into retail sales data, we had a slight bump in March with almost completely correlated to the tax refunds. And I caution CEOs, it's like an insulin shock. Like, you got a little bit of it from those tax refunds, but that's going away.
If the K is here to stay, does it get more pronounced? And the reason I ask is because if wealth concentrates with a smaller group, but they get more and more of it, and then a larger group gets less and less, then that's a recipe for political unrest.
It's a recipe for political unrest. I have the very annoying "it depends" answer onto whether or not it accelerates, and it comes down to those 3Ds. If duration is long, if devastation is there, and disruption happens, then the K will definitely exasperate, because that's what's going to happen. Energy is a small percentage of daily spend for an American consumer, but energy as an input is a large percent of that monthly wallet. And wages are relatively stagnant in the U.S., especially at the lower part of that K. So we are getting very distracted by headlines that say, hey, the U.S. GDP is growing, equity markets at an all-time high. Those headlines are all true, but it disguises a very nuanced storyline that matters to the majority of companies in the U.S. who have to serve both parts of the K.
Okay, layer on top of that artificial intelligence.
Yes.
Coming up also, our conversations came up at Milk, and I can't remember who it was, but I think it was one of the big PE giants, but just saying that blue-collar jobs, it's going to be great for all the building, but you're not going to be building forever. Yeah. So at some point that goes away. But when you layer AI on top of it, what are you hearing from executives and heads of organizations? Are they like, I don't know the cost, or it's making it so that I don't need as many people in the office?
Very few. The headlines about replacing jobs with AI are incredibly overstated. There are only a handful of companies who have actually replaced jobs with AI. There's other R's that we're seeing. It's reallocation, right, and restructuring. So a lot of spend is being reallocated. I've got X billion dollars in free cash flow. I need to now fund the data centers. I'm reallocating from hiring new teams, or I have to lay off teams to do that. We're also seeing restructuring. A lot of companies were not fit for growth, right? They have been over-bloated, too much hiring since COVID. We see that very empirically. There's a restructuring going on, and frankly, a rectification for some past lack of discipline. So those are the R's that you're seeing. Now, Carol, the data is showing that on entry-level jobs, there are less job openings at the entry level, and that is where we're seeing a bit of it. So right now, as far as the empirical data, it's case studies, and it's the younger worker entry-level job.
I will say we're going to hear from Block after the program today. They're reporting. And
yes.
I mean, I feel like you were talking about that was the criticism when they announced those big layoffs, that there was all this
bloat. But Block
bloat.
also built a dual business model for several years with two companies that they put together, which led to a lot of this as well. And I think this is the issue. Every single company, and there are very few who are doing these amount of layoffs, there's a real organizational reason behind it. Now, I'm not saying it won't happen.
Right.
But where AI is in most organizations now, it's still what I call dabbling. There's a small percentage who are being deliberate, and even smaller percentage who are directly linking it to value creation outcomes.